Good evening, everyone. Jerry D'Ambrosio here, and it's my pleasure to introduce this week's special presentation, Turning Market Declines into Gains. Shorting stocks during market declines can provide investors with a strategic advantage, allowing them to profit from falling prices while hedging against potential losses in their long positions. This practice not only enhances portfolio diversification, but also offers a means to capitalize on market volatility, turning downturns into opportunities for gains. Additionally, shorting can help investors manage risk by offsetting losses in other investments, thereby stabilizing overall portfolio performance. And that's really the theme here today. I'm not saying, hey, let's go run out on Monday and short 10 stocks. What I want to explain here is shorting stocks can be used as a hedging mechanism during market pullbacks. There are times where you don't want to sell long positions in your portfolio. Maybe they're core holdings. Even those fundamentally sound, strong stocks, will struggle during market pullbacks. And shorting stocks is just one example on how we could offset those losses. Other examples are covered calls, buying put options, inverse ETFs. We've talked about that before. But today, I want to talk about shorting stocks as that mechanism. So let's talk about the basics of selling short. You can't just go log into your broker and start selling stocks short. There are some requirements and some explanation that needs to be done up front. Suppose an investor short sells 500 shares of XYZ stock, which is priced at $20 per share, generating $10,000 from this sale. So what we're doing is we are selling an asset that we do not currently own. The sale of that asset generates capital that is deposited into our account. Now, if the price of XYZ stock drops to $15 per share, the investor can buy back 500 shares for only $7,500. After repaying the borrowed shares, the investor nets a profit of $2,500 from the short sale. So you sell short a stock at a certain price. The hope is for the stock to drop in value so that you can buy it back at that lower value, keeping the difference between what you sold it for initially and what you bought it back for. So that's just the basics of selling stock short. Again, you can't just log into your account and start shorting stocks. What you first have to do is open and fund a margin account. Assets in that margin account serve as collateral. There's an application process. You wait for approval after you fill out the application. Once you're approved, you sign a margin agreement. That margin agreement just lays out the terms of the account. Interest rates on borrowed funds, margin requirements, things like that. Once that's done, you fund the account. So you make your initial deposit, and again, that will serve as collateral for short selling. Once all that's done and you're ready to move forward, you identify short sale candidates. So there are some prerequisites here that we want to make sure that we follow. First, make sure the market is falling. A red light in the price column of the color guard, for example. A DEW down signal, a confirmed down signal. Maybe the MTI going from above 1 to below 1. It doesn't have to be one market timing signal. Just make sure that the market is falling and that it's in a downtrend. So those situations there meet that criteria, right? Red light in the price column, we know the market's falling day over day and week over week. DEW down, confirmed down, things like that. Once you identify a falling market, next is you want to favor overvalued stocks with poor fundamentals that are falling in price. This is the mirror image or the opposite of what we would look for if the market was rising and we were looking for stocks to buy. We favor undervalued stocks with strong fundamentals that are rising in price. So it's just a mirror image of our bullish analysis. Identify entries and exits before entering the trade. That doesn't change. You never want to risk more than 1 to 2% of total portfolio capital on any one position. That doesn't change as well. Same rules apply for if you're shorting stocks. Step 3, make sure you know all the rules and fees associated with the transaction. Firms have different rules and borrowing fees, so it's very important that we understand what they are. Some brokerages do have stronger inventory to lend you, because again, you're selling something out into the open market that you don't already own. You get those shares from either your broker or other investors. Some brokers have stronger inventory and are easier to sell stocks short. So shop around and be comfortable with the fees associated with selling short. Step 4, initiate a short position. Sell short certain amount of shares. Use limit orders as well. It better controls your cost basis. And then finally, after you initiate the short stock position, you buy the stock back at a lower price, pocketing the difference. You return the shares to the lender and pay interest on that loan. So those are just 5 simple steps to shorting stocks. I'm going to hop into the VectorVest program now, and we're going to go through a few of those. Obviously, I'm not going to walk you through opening up an account or funding that account, that margin account, but we're going to start off with step number 2, and that is identify a falling market. So market trend and placing short stock trades when the market's falling, very important. And going back what I said earlier about, hey, I'm not saying let's go short 10 stocks on Monday. This can be a very selective exercise here. If the market starts to fall and you get these bearish signals, like the primary wave down with a red light in the price column of the color guard, MTI falling from above 1 to below 1, DEW down signal, those are your signals letting you know that it is okay to short a stock if you want to put a hedge on. Remember, this is just a simple hedge, and that's what I really want to emphasize here. It's the same as buying a put option as insurance. It's the same as buying an inverse ETF as insurance or as a hedge to your long positions. It's the same as selling a covered call. Now, the mechanism is different with each of those, right? But the concept is the same and the objective is the same. To offset losses on your current long positions, and you can do that by opening up a short position. Could be 1 position, could be 2. Again, not saying go out and short 10 stocks on Monday. So if we just look at the current market, we could see that on October 22nd, we did get a red light in the price column of the color guard. Let me expand the color guard a little bit here. Change it to medium. And you can clearly see the transition that occurred or has occurred over the last couple of days, right? If you go back to the beginning of October, you had a lot of green lights in there. The market was rising. The trend was strengthening. The buy-to-sell ratio was increasing as well. Things changed a little bit recently. Over the last couple of days, the market has rolled over. Now, the MTI is still above 1. So technically speaking, we are still in an underlying uptrend, and we're still in a confirmed up call, right? So the underlying trend of the market is still up. However, the short-term trend is down. Undoubtedly, you're going to experience portfolio drawdown. Long positions are likely to come under some pressure during these times where the market rolls over. The red light in the price column of the color guard there is your signal to help offset those losses. And again, opening up a short position is how you do that. If I go to October 22nd on the market timing graph, there it was. So let's back up a couple of days. There was October 22nd on the market timing graph. Here's the VVC. Doji just a few days prior. VVC did make a new high, but it has begun to roll over. Red light in the price column of the color guard was given on October 22nd. What we want to do is wait for follow through the next day. We got some follow through the next day, didn't we? October 23rd was a pretty tough day in the market. The market did follow through. It opened lower. It continued to move lower throughout the day. So October 23rd would have been a good day to take on a short position. Let's now talk about, and that's on the market side, right? So let's be clear on what we need to see on the market timing graph with the color guard to initiate a short position. Those signals are important. We're not going to short a stock with a green light in the price column of the color guard, even though we think the market is overextended. Maybe the MTI is above 1.5, 1.6, and the market's going up. Let me put the MTI on. Go to the last 1 year. Good example here. Just because the MTI goes above 1.5, and it did so there, doesn't mean the market's going to roll over and turn the corner immediately. Sometimes it takes a little longer. But when it does start to roll over, and red lights start to appear in the color guard, that's a good time to, again, initiate a short position. Same thing here. Here's the MTI beginning to roll over. That's when it first crosses below 1. That would have been a good opportunity to take a short position to offset losses in your long positions. Same thing here. MTI crosses from above 1 to below 1. So I'm just going through a couple of different signals that you may want to consider. It's not just one signal. It's nuanced in a way where you have to follow multiple signals, understand what the market conditions are, and then make the appropriate decisions. Right now, it's very early, right? We're only 3 or 4 days off of the actual high, and I don't know if the market's going to continue to move lower or rally from here. But you're prepared. You consider it almost an insurance policy on the long positions in your portfolio, again, to help you offset losses. So if I go to Unisearch on October 22nd, again, very important date because it was a red light in the price column of the color guard. If I go to Unisearch on October 22nd, and I'm just going to point out a few of my favorite shorting searches, and this goes to now step number 4 is initiate a short position. We're going to go through now the types of stocks that we want to consider shorting. So if I open up the search as short folder and go to this search here, Doug's Downers Supercharged. If I just run that, look at the parameters of the search. We're looking for negative earnings per share. We're looking for negative earnings growth. We're sorted by EY times RT ascending, bringing the stocks with the worst combination of earnings yield and RT to the top. These stocks have to have a sell rating. This is just the absolute opposite of what you would look for if you were looking for stocks to buy. Look at the price to value comparison on a lot of these. These are overvalued stocks. The fundamentals are poor. RVs are below 1. RSs are below 1. RTs are below 1. CI ratings are well below 1 as well. You can see most of these have negative earnings growth. Actually, all of them have negative earnings growth because the search is looking for that. So these are the types of stocks that you want to sell short. So if I graph these and back us up just a couple of days, I want to make the hard right edge there October 22nd. That was the day that we ran the search. That was the day that the red light appeared in the price column of the color guard. So taking a look at the last year, here we're looking at EVTL. Stock has been in a downtrend, pretty volatile. Over the last 3 months or so, what has the stock price been doing? It's been falling, right? It's been hitting lower highs and lower lows. I actually drew these extended lines on this chart to pinpoint the lower lows and the lower highs. Just recently, again, October 22nd, the stock rallied from that lower channel line and kissed the upper channel line. This is a really good short stock position if the stock price the following day confirms. If it retraces from that upper channel line, that is an absolute excellent setup for a short stock position. So that would be one that I would consider taking. If we go to the next one, just back up again. Again, mirror opposite of what we would look for if we were buying. The stock has been in a downtrend now for the last year. Looks like the downtrend is accelerating as well. I think this one just recently split. It did. You can see the volume drying up here as well after the split. Stock price has been consistently falling. Let's go to a 3-month chart. Rallying over the last couple of days. So no real follow through on this one. You can see here October 22nd was right there. So if we back this up just a couple of days, if I were to look at a stock chart and I was considering shorting a stock, this is what I would look for. Stock price consistently falling. In this case, the stock has rallied over the last couple of days, but it's done that a number of times over the last 6 months, hasn't it? And what's happened? The stock price failed to continue to move higher and then broke down and continued to create lower highs along the way. That's the expectation here. So on October 22nd, you had a little rally, but you had a down day on that day. Again, that was the day that the red light came. You got follow through the next day, and that would be a nice opportunity there to initiate a short position. And if I just go through these quickly and just continue to illustrate and emphasize that these are the types of stocks that you want to be shorting. Look at this one. NVRO continues to make lower highs and lower lows. So if you did this, if you were paying attention to market direction and identifying when a bearish market timing signal occurred, again, let's review. Red light in the price column, DEW down, maybe even an RT combo down signal, because that signal will offer up more bearish signals while the market's falling and building momentum than, say, just a confirm down or the DEW down, right? You get one DEW down, you get one confirm down. With the red light in the price column of the color guard or the RT kicker combo, you get multiple signals. on the downside. So for example, if I can actually put the RT combo signals on the downside here, you can see RT down here, RT down here, a couple of RT market signals. These are market signals, right? These are not stock signals, but these are market signals that are overlaid on the stock graph showing you when the market signal did come, what did the stock price do after that? So while we haven't gotten an RT combo signal, down signal recently, we still have a red light in the price column with the color guard, which gives us an opportunity. But just going through these charts, I mean, these are the types of stocks that you want to consider shorting, right? Mirror opposite of what you would consider buying when the market was rising. So that was Doug's Downer Supercharged. I also like Pirate Short. Pirate Short's a good one. Looking at the parameters here, now we're looking for stocks above $10, not equal to a buy, so the recommendation not equal to a buy. Sorted by VST times EY ascending, looking for the worst combination of both of those indicators. Looking quickly at price to value. A lot of these stocks are overvalued quite significantly. Poor fundamentals, falling in price. Look at the CI ratings, negative earnings growth. So this is a very important part of the exercise. There's a few different parts here, right? There's market analysis, there's stock selection, which is what we're doing here. There's also money management. If market conditions quickly change and your insurance policy isn't paying off, you'd want to consider closing the position, right? If this was just a hedge and you shorted a stock or two, but you still have 7 to 10 long positions in your portfolio, you see the market falling, red light in the price column, you get follow through the next day, you initiate a short position. If the market changes direction quickly, again, that insurance policy isn't helping you, so you want to close the position. One of the guidelines that we talked about earlier is never risk more than 1 to 2% of your overall portfolio value. That's going to help you stabilize or keep your portfolio stabilized and not risk too much on any one position. And by doing that, your portfolio won't blow up during times when volatility picks up. So thank you for joining me here, folks. Hope you enjoyed today's special presentation. Shorting stocks or any defensive mechanism is really crucial for long-term portfolio stability and performance. You're not going to get there just by buying stocks and going long. There are some defensive techniques that need to be applied so that you can really see your portfolio grow long-term. Thank you, everybody. Have a great rest of your day. We'll see everybody next week.